Hi, so today we're gonna pick up where we left off with our valuation model by explaining how to calculate this WACC if that's how you choose to calculate your discount value. Once again, I don't really subscribe to this method. I find it much better to use the stock market return here to get a more conservative estimate. However, if you want to do it by the textbook, we're gonna explain it today. So the WACC equation is very simple, very simple. Basically, you take the ratio of debt in a company and you're going to multiply it by RD, which is your cost of capital. So basically, this is the cost of debt capital. So this is going to be your interest rate on your bank loans, on your corporate debt. If you have bond issuances, this is going to be your cost of debt. And then here is your ratio of equity to debt plus equity to liabilities, which we'll go over in a later video, more on the balance sheet, times your, this is what's called the cost of equity. So this is similar to this. This shows your percentage payment of debt. This is going to be the cost percentage that raising new equity would have on the company. Say they issue more shares, this is going to be the percentage that they cost, because you don't get all the revenue from issuance of new shares. There's costs related to that. So this is all going to feed into weighted average cost of capital, which is basically what it says and what the equation we walk through kind of goes into. It is the average cost of the company acquiring more money or capital. Now this 1 minus t term, it is kind of important. Sometimes it's excluded, but basically this is your tax rate, and you're going to want to multiply this by that debt component of the equation. And this basically takes into account your tax kind of shield from having debt. So this is going to go into the DCF equation right down here if you want to do it textbook way. And we're going to talk about how to kind of get an expected return for a stock. This is a good mechanism of also calculating the RE in this WACC equation, because this will give you your expected return on capital. You can use this to calculate this RE. There are other methods as well. So basically, this looks pretty complicated, but the RF is your risk-free rate. So the risk-free rate, we usually use short-term treasuries. So we see that the 13-week treasury bill is 5.2%. I think I have it a little bit higher, but I have it on a slightly shorter time scale, and right now the yield curve is inverted. And we'll go into that in future videos, but 5.2% would be this RF factor. And so this, in the parentheses where it says RM minus RF, your RM is basically your average return on the stock market or an index that you pick, so the S&P. So in this type of equation, I would usually use 10 or 12% for this, because of course the S&P averages 10 to 12% over the long run. So this term right here in parentheses is called your market risk premium. And from a basic standpoint, it's basically how much more the market is returning than the risk-free rate. And you're going to multiply this by your beta. Now, you've probably seen this. It will show it on every stock. Pretty much every service does this. Your beta here, 1.31. So a 1 beta means that you're perfectly correlated with the stock market. And we might go into the equations in a later video because they're a little bit more complicated. It takes into account statistical analysis, basically how close it follows the S&P 500 in a linear regression model. So a 1 would be perfect correlation. A 1.31 like we have here with Apple, that would mean that if the market does good, this will do better. If the market does bad, this will do worse. It's a little bit more, it's going to move more than the market. If the beta is less than 1, it's going to move less than the market. So a good company to maybe illustrate this would be J&J. They have a beta down here of 0.57, so they will move very slowly compared to the market, and we can even see this looking at the 5 years. You see it moves very little in comparison to other companies. So basically you're going to want to multiply that by the market risk premium and then add that to the risk-free rate, and you'll get your expected return on the stock. So I would not use this to invest solely to come with a valuation. I suppose you can, but in finance this is really useful in that you can plug it in to this cost of equity. The next videos will go into a bit more on the financial statements and the basics, but I wanted to get valuation out of the way because I feel like that is the most crucial and fundamental part of investing. But we'll go into the actual fundamentals in the financial statements to show you how to find good companies, not just how to value them. Thank you very much. Hope you have a great day.